In today's episode of the Scholar Advising Podcast, we're going to answer three big picture questions. One, we're going to look at windfall considerations, what to do with cash once it's received after a startup exit, how that impacts spending, thoughts about philanthropy and charitable giving. And then we're going to look at some tax advantages or lack thereof of two high earners. And finally, we're going to jump into one that's related to both. Spending on a vacation home, whether or not that should be considered an investment, where that line gets drawn, and some considerations from spending that comes in. At the end, we'll bust a common financial myth about the backdoor Roth. So let's jump into it. So the first question we have up on the agenda today: I sold my tech startup for 8 figures and don't know how to balance paying off my mortgage, investing for retirement, and starting a charitable fund. Where should I begin? So I think the big key here is to really take a step back. Whenever there's a big windfall of cash, whether it's from a sale or an inheritance, the best thing you can do is do nothing for a little bit of time to really think about overall objectives, what you're trying to get out of this whole amount, because you're talking about a life-changing amount of money, and contrary to some overconfidence biases, is likely one of the few times you're going to have this amount of money, if not the only time that you have this amount of money hit your accounts, which increases the amount of risk associated with it. Also can increase a lot of anxiety around what to, as we're getting from the question here. So we want to start first with taking a step back and starting to think, what does life look like in this second act, so to speak? Where's charitable giving in there? Where is the amount of money you're going to need for the lifestyle you're wanting to live? The mortgage repayment. So I already have a house in place. So then the question then is that the permanent house now, or is that the house that you had pre-sale that was not up to the standards that you've now set for where you want to be? And a lot of that has to do with location. But assuming that you're going to stay, and even if you were going to move to a new place, paying off the mortgage is an easy win. And especially with rates where they are now, even if you have a locked in rate that was significantly lower, I've never once heard someone regret that they paid off their mortgage, especially in a situation that you're in with likely financial independence being reached. So paying off the mortgage is a low hanging fruit to just not have to worry about it. You're not going to have that concern. And then there comes the question of, how do we start handling future security? And this goes hand in hand with the charitable discussion, because we want to be careful. It can be really easy to say, well, I have all this money here, so I'm just going to go take half of it and go dump it into some charitable organization or some donor advised fund and get the tax break. And that's a really hard decision to make, because the tax break looks so good, especially in the year of the sale. But because it's in the year of the sale, it causes a lot of pressure to make that decision early. So you have to really fight it back against that. What is the lifestyle you're wanting to live? Let's start looking at how much money you need for that lifestyle. There's lots of rules of thumb out there with withdrawal rates or running Monte Carlos, but trying to figure out, if I'm going to spend $400,000 a year, then I probably need somewhere around that 15 million mark, right? The $10, $15 million mark in cash. And then anything above that, that's a great opportunity to start thinking about charitable contributions. Now, when it comes to charitable giving, you're going to have two paths that you're going to go down. You're either going to go the donor advised fund route or the private foundation route. Private foundations, the downside there is you're going to have some additional tax reporting. You're going to have some legal fees that are going to be associated with it, and time, right? It's not just write a check and go as you would with a donor advised fund, where you really can write a $10 million check. It gets sent over and you're done. The private foundation, you're going to have a lot more control over where that money goes to. You're going to be more intimately involved with the process from beginning to end of where that check is going, how much are you writing, investing the money that you have separately from your own personal finances. There's not as big of a tax break, but it does give a lot more control. So if part of your goal post exit here from the startup is that you would like to be more involved in a charitable way, not just the check writing, then a foundation can be a good idea. Generally, we start to see that above the $10 million in charitable giving is a good spot to start considering the private foundation. because at that amount, you can start making some pretty big impacts in a local community. And that tends to be where people want to drive a lot of their charitable giving, to a local community. And instead of giving a check to a local foundation or a local charity, you can actually be the person who is writing the check to the people directly to who need it. So that's always a good option. A lot of that decision for charitable funds has to do with how much time you would like and how involved you want to be in that charitable giving. So that's a good one. Congratulations on that one. That's a great spot to be in. So next question that we have up on the list here. We're both doctors with a high combined income. How can we reduce our tax burden while still saving aggressively for retirement? All right. So this is the age old question, right? Unfortunately, doctors, physicians end up being put in this kind of odd spot because while income is high, it's usually W-2 income, which is the least ideal income that you could have. When you have income from investments, there's lower capital gains rates. There's more control over when you're realizing gains. Real estate, similar scenarios, as your depreciation benefits there. Self-employed income, lots of options with types of deductions. And there's a lot of government incentives for business owners to promote people to own businesses and run businesses. However, if you have a dual high income W-2 job, it does limit significantly the options that you're going to have. You can start with, consider the low hanging fruit here of maximizing the accounts that are available to you, whether it's a 401k, 403b. You start looking at things like HSAs. If you're at the hospital, 457 starts to be a good option as well. But then you really start having to think more strategic about what future you is going to look like, what your future accounts are going to be. Because right now, right, assuming that you're starting off in this range, I know ages, a lot of your success and saving aggressively for retirement, if we take that piece of the question out, is going to be driven by your own contributions. So it's really easy for someone right out of residency or fellowship to get really caught up in returns. And I hear it regularly. It's like, well, I want to be an aggressive portfolio. I want to be in this type of portfolio and try to squeeze out every percent of return I can. But the reality is, if you're saving $100,000 or $200,000 that year, say it's $100,000 to the accounts in aggregate, and the market does well and has a 10% year, you put in 100, the market put in 10. And the next year, you put in another 100, the market maybe puts in 10, 15. You are doing the lion's share of the work to get these accounts up. Right? The market is not helping you in any way here. Later on, there's switch, there's role shift. And what ends up happening is that toward retirement, your accounts are throwing off all of the income and your contributions start to become immaterial to the success of your portfolio or to your ability to retire. And that's why you reach a point of retirement, is when your contributions to the accounts are no longer the big driver of that success. So in this case, saving aggressively for retirement, what do we do? Reducing taxes. You have your tax advantaged accounts. Those are always great options. You do have to be careful with the 457 of getting that account being too high, because there's some risk there of that money still being owned by the organization, since it is deferred comp. Roth conversions, another option for doing some backdoor Roths. Again, easy, low hanging fruit. And if you have account values that are in an IRA, you can still do a backdoor Roth. You just need to roll that IRA balance over into a tax advantaged account. So backdoor Roths are a good one. If we think about where we're at right now, two earners, let's say 403Bs, you're in that low 20s limit. So we're saving 50 now on the 403B. We're doing some Roth conversions. So that's another 14 or so to the account. So we're at 65. We use some 457s as well. That gives you another 50. So just to get out of tax advantaged accounts, 457s, Roth conversions, you need to be saving over $100,000. And that's where, despite the lack of tax benefit, that's where I think a great and missed opportunity is of starting to build up a taxable account. Right? And really start to be pointed about how you're handling your savings to taxable investments, because it's an easy trap to fall into that I'm going to max out all of these other accounts. and not have any liquidity available to you for anything else. Other deductions that tend to exist, you can get into the charitable game, as we were just talking about, that you have those same available options, donor advised funds and everything. But if you're saving aggressively for retirement, my guess is that you're needing retirement savings and you're not at a point of saying, I don't need this cash, so I'm willing to give it to charity or put it in a donor advised fund. So that's not likely the option. Depending on where you're at, if you're in a private practice, you tend to have more sway in the types of plans that are available, where you may be able to push for a mega backdoor Roth, which is always awesome. If you can do a mega backdoor Roth or set a mega backdoor Roth for you, that is a fantastic move. Some hospitals have this available as well. Definitely something to ask for. This allows you to put significantly more after-tax savings into your 401k and then convert it. Now you're saving $70,000 a year into a 401k. So those would be the options for the dual income doctors that we're dealing with here. All right. Question number 3. My spouse wants to buy a luxury vacation home as an investment, but I'm worried about tying up cash. How do we decide if this is wise? So first issue here is very big definitions of luxury for different income levels of different vacation homes. I will say that looking at a vacation home as an investment is probably not the best idea. If anything, you're looking at it most likely being at best a neutral cash flow situation every single year. And that's if you're renting it out. So for instance, you go buy the beach house and you'll get the pitch from the real estate agent that it's a great idea because you can rent it out. And the unfortunate part is generally the time you're renting it out is also the time where you would likely be wanting to use the vacation home in the summers and everything else. So you're stuck renting it in times where there's not as much demand. It's not necessarily a bad thing, but in times where we've done a lot of analysis into the vacation home purchase, it should be thought of as likely a net worth neutral decision. What I mean by that is you're taking cash from investments, pulling it over to an other asset, this non-income producing asset. So you're missing out some opportunity costs of the investments, right? But it's not disappearing. You didn't just go light that money on fire. It depends on the type of vacation home you bought. But for the most part, hopefully you're buying a house that's in decent shape and you're going to take the money, buy the vacation home, and it's just going to sit there. And generally the appreciation of it should match inflation. So you shouldn't be looking at it from a gain perspective of being the solution to retirement, right? That's the one that I hear regularly is we're going to buy this house, and by buying it, we're going to be set because we're going to have this asset. But I don't think it's a horrible asset purchase because it's still there, right? The asset still exists. So in the future, if you needed liquidity or you needed cash, you could sell the vacation home or you could pull equity against it. So that would be the first look, is I would get the investment word kind of out of your mind, just because if investment and vacation are generally not used in the same sentence. If you're buying a home as an investment, that's one thing. If you're buying a vacation home, that's another thing. In combination, they kind of wash each other out. Now, you have to be careful about that because the cost of having that vacation home is not just the upfront cost. There's the carrying cost of the house as well. In other words, you have your maintenance, you have taxes, you have insurance, but there's also a huge cost that never gets brought up. And that is the lifestyle inflation cost of this new luxury vacation home. Right? There's an effect called the Diderot effect. And the Diderot effect is that whenever you buy something that significantly changes the lifestyle that you live, the risk you run is that other items and other expenses that you make will now have to increase to the level of this new item. And so think about this as this luxury vacation home being a lake house. You go buy the lake house and you have your spreadsheet, you have your maintenance costs, you have your taxes, you have your insurance all figured out. All of it's beautiful, right? You have this great spreadsheet and it's showing that you break even after you rent it out for a couple months and after paying the commissions. And you're using this as justification. You say, this is it, right? This is why we can buy the lake house. The issue that's not being taken into account as part of that spreadsheet is that lake houses are no fun without a boat. And so you buy the lake house, but then you're going to go want to buy the boat. And then boats are no fun without a jet ski. And no one just buys one jet ski. Now you got to have two jet skis. And then you're going to need the truck to pull the boat. And then you're going to want to invite friends out to the lake so that you can have more parties out there. So there costs a different social upkeep as well. And this becomes the separation of that investment versus vacation home aspect. You're going to have a different level of decor and a different level of dock and upfittings to the home if you're using it as a vacation home, as opposed to if you bought it solely as an investment for other people to use. So those are the costs that are never taken into account. It's not just the upfront cost. It's not even the ongoing maintenance cost. It's the cost of the lifestyle that you now have with this new home in your life. So now let's say it passes all those tests, right? You've gone through and you've determined that it can happen, and you've determined whether or not this is truly a vacation home or investment. And we're going to assume that it is now a vacation home. You factored in all of your costs. It still looks good. You factor in added expenses of this new lifestyle that you're going to have. Now the next part is, do you really want a place in this area? Because vacationing somewhere is very different than living somewhere. I always recommend making sure that before you go make this purchase, that the location you are buying in truly is a place that you want to be. Right? Take multiple vacations there, not only on the weekends, not only on Memorial Day and 4th of July. Go in the middle of winter, go in random times throughout the week and stay there for a few days. Go to the grocery stores, go see what's out there. Because unfortunately, a lot of times, some of the greatest vacation homes are in areas where it's absolutely miserable because there's no restaurants. The nearest grocery store is 30 minutes away. You have all of these other factors, which can be a deterrent. Not always, but are something that you want to make sure are taken into account as part of this purchase. So that would be the overall thoughts there on the vacation home. Be careful of the Diderot effect, making sure that's being factored in. Really nail down whether or not you're buying this as an investment or as a personal use. And neither of those answers are bad, right? There are expenses that you're going to have that it is okay to be consumption. And what I mean is, not every purchase you need to make needs to have the purpose of being an investment in earning money. And if you're in this situation, there can be many other benefits that come from having this second home or vacation home that are not quantifiable on a balance sheet or a net worth statement. So this week's rotating special segment is Myth or Money, where we bust a popular financial myth. Today's myth is one that we actually covered in some of the questions, or at least alluded to, which is, I have an existing IRA, so I can't do a backdoor Roth. And what's rough about this myth is that it is technically true, but it can be resolved. So if you have an existing IRA, you cannot do the traditional backdoor Roth process because you have an existing IRA balance. When you go through a backdoor Roth, what your goal is you want to be able to add after-tax money that's already been taxed to your IRA and then convert that money over to Roth. And as you do that conversion, you would pay tax on any pre-tax money because you've already paid tax, and that's an after-tax amount. There's no tax on that conversion. So that's the premise of the backdoor Roth. The issue is if you already have a balance in your IRA and you add after-tax money to it, now you have these commingled funds where you have some pre-tax money and you have some post-tax money. When you go to make this conversion and you go flip that money over, you are going to have to pay tax on that pre-tax amount. Now, if you only have $2,000 to $3,000 in there, maybe you funded it for 1 year at $7,000, that's not going to be as big of a deal. But this becomes a big deal when somebody goes and say have the 401k and then converts that or rolls that over to an IRA. And now they have hundreds of thousands of dollars sitting in an IRA, and then they want to do a conversion. You can't do it cleanly with a existing IRA, but you can roll your existing IRA into your current 401k. So if you change jobs, rolled over 401k to an IRA, and now you have a new job with a new 401k, you can absolutely take that balance, roll it into your new 401k, leaving you with the zero balance in the IRA that you need to be able to do the backdoor Roth. So while technically true due to the pro rata rule, you can't do a backdoor Roth with an existing IRA. I'm going to call it a myth on this one because you can eliminate that problem very easily by rolling that IRA back into a 401k. Now, the related myth to this one, if you're going to call it a bonus myth of the day, is that I make too much, so I can't do a Roth. And again, true, because there are limits to the Roth, but the two ways that we see this being a opportunity is, one, you can still do Roth contributions to a 401k. Number of people that I talk to that don't realize that they can click that Roth box in their 401k option because they assume they make too much is astounding. Just because you can't make a Roth IRA contribution doesn't mean you can't make a Roth 401k contribution. There are no income limits to a Roth 401k. Now, the backdoor Roth exists. So even if you make too much to be able to contribute to a Roth IRA directly, you can contribute after tax to an IRA and then do a conversion. That's where the name comes from of a backdoor Roth, because you can't directly contribute to the Roth, but you can do so through the conversion process of after tax money. Hey, this is Stefan Scheib. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, just send us an email at podcast@scholarfinancialadvising.com. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.